If you've ever looked at your balance sheet and felt unsure about what the numbers are telling you, what liabilities really mean in your business, this episode is for you. Liabilities aren't just about bad debt. When used correctly, they could be a powerful tool for growth. When are they not? When they drain your cash flow and put you in a tough financial situation. In today's episode, I'm covering three things: the different types of liabilities in your business, why comparing assets versus liabilities is important, it's vital. More vital than you think, and how liabilities can impact your cash flow both positively and negatively. Stay tuned. Welcome back to another episode of Harmonious Wealth. I am your host, Iyanna Vaughn. I feel like if you're watching on YouTube, this is like really covering my face. Okay, so much better. Girl, it was like all up in my face. And I'm like, I can't even see my notes. But welcome back, welcome back, welcome back. We were on a journey. I was taking you through the financial report. And today we're still on the balance sheet. I want to show you that your balance sheet can be your friend because she's the girl that's going to really tell it like it is. You know, the P&L can be a vanity metric when we're thinking about like revenue, when we're thinking about expenses and profit, all those things like that. But when you really look at your balance sheet, and if that is correct, if your balance sheet is accurate, then you know that your entire financial reports, all of your financial reports are accurate. So we're picking up where we left off. Last week we talked about assets, and that talks about what you own. And today we're going to be talking about liabilities, which is what you owe. Now, I'm not sure if you remember, but a few seasons back, season one, I talked about attachment style with money. I'm a huge fan of attachment styles, and I love talking about your attachment style and money. So, we know that attachment styles can show up if you're secure, and then the insecure portion is like anxious, avoidant, and disorganized. We won't get into that today. I want to talk more objectively about your liabilities. So stay tuned for a future episode when we talk about just like your behavior and money. But in today's episode, let's talk objectively about liabilities. So again, we're covering the different types of liabilities, why you must compare your assets versus liabilities, and how liabilities can impact your cash flow in your business. First, let's define liabilities. So, a liability is what you owe in your business. We talked about assets, what you own. Liabilities is what you owe. Equity is what's left over. And that can be what your business owes, whether it's money, services, or future obligations. And they appear on your balance sheet and they play a role in your financial health. Now, the main liabilities we have your current liabilities. That's basically what you will pay within the calendar year. And then we have long-term liabilities, and that's kind of extending your cycle. So it might be like a long-term loan. So current liabilities are again due within the year, and they can be like your accounts payable, which is when you have like a project-based business and you're executing on that project and you might pay that vendor 30 days later versus like in real time. And if you're tracking that on your accounting platform, you'll be able to keep track of, okay, what all do I owe in my business so that it's not a surprise to me when it actually comes up and I have to pay it. Another current liability is your credit card balances. Now, this is, for short-term spending, or if you just want to relieve cash for a little bit, you can use that. Again, this is objective. I'm not going to get into behavior, but we know how sometimes we can behaviorally not keep the best track of our credit cards. So, another example of current liabilities is your payroll liabilities. So, an example of this is if you are running payroll and you have benefits. When you run payroll on, let's say, the Wednesday, right? And the funds don't get taken out until that Friday, it's kind of a liability until the cash gets taken out. But even then, if you have benefits where your 401k comes out after payroll, but it's the same payroll cycle, you probably will have a short term liability of whatever gets held from or withheld from payroll, so then you can pay your 401k provider. So say if you see that on your balance sheet, it's like a timing difference. So if I run payroll at the end of February and by March 1st or March 2nd, they finally take out my benefits from our 401k, I will have a temporary liability on my balance sheet for my 401k contributions. Not a big deal. It's really just a timing difference and just making sure that we account for everything. Okay. So, long term liabilities, again, are extended beyond 1 year. They could include like your business loans, right? They can, like, say, if you are on a term loan, um, your term loan is basically the term of use, whether it's 6 years, 5 years, 3 years, 10 years, whatever that term is. If it's more than a calendar year, it will be considered a long term liability. And lines of credit, um, it could potentially be short term because you kind of like it's like a revolving, you kind of pay it off and then you use it, you pay it off, you use it. So that it could actually be short term. And when we think of liabilities, they are all not bad, but we must be able to keep a hold on them by understanding how to use them. And that brings me to my next point, okay, which is why you must compare your assets versus liabilities. So there is a nifty metric that probably doesn't necessarily get used in small business, and that is called the debt to asset ratio. So what that means is let's scale back a little bit. So when we're looking at our revenue, and we're ignoring our liabilities, that we're missing a big picture in business because you can have as much profits as you'd like, but if you are just really struggling with your cash flow and you're paying off debt, your debt becomes like a bill, you're really misunderstanding how your cash flows in your business. So if assets are greater than liabilities, chances are your business is relatively stable, right? But if your liabilities are higher than your assets, that means we got to figure things out. We have to figure how to decrease your risk and your cash flow risk in business. Similar to your credit, when the bureaus don't like when you spend more than 30% of your credit limit, we want to create a similar view of your debt to asset ratio. So ideally, your credit or your debt to asset ratio should be no more than 30%. So pause the video right now, look at your balance sheet as of last month or last year, take all of your liabilities, divide that by your total asset, and then see what that ratio is. If it is over 30%, that means that there's some, we got to figure things out. Let's see how we can increase your assets. But if it's under 30%, yay. And again, this is objective, objectively looking at it. We're not going to talk to ourselves negatively. We're just going to see what that debt to asset ratio is and then plan accordingly so that we can ideally increase profit, to ideally increase that cash flow, to then increase your debt to asset ratio, or for the meantime just kind of knock out some of that debt, get it at 30%. Then that way you're able to eventually increase your debt to asset ratio. So we know that if your liabilities are increasing, we want to ensure that your assets, which include your cash on hand, accounts receivable, and like your equipment, things like that, are growing too. Now, we want to make sure that your current assets are growing, not just like long-term assets like your equipment and all those things. And then we want to also make sure that you're getting paid and your accounts receivable isn't always just so high and it's way higher than your cash on hand, but you get the point. So, again, if your debts are higher than your assets, we want to rethink how you're spending and really have a profit plan. That's why it's important to have a profit plan. And if you're in need of a profit plan, I have a great tool for you. It's called the Harmonious Cash Flow Planner. And the Harmonious Cash Flow Planner will help you understand like where you are with not only like your revenue, your expenses, your profit, but also your cash on hand. And what I want to also include is that we can kind of keep track of what you would pay in debt It's not going to give you your balance sheet, but it's going to tell you how you can plan out your cash flow so that if you do have any lingering debt, we can actually you can actually account for it, and then you'll be able to not have or cease your cash flow surprises. So if you are interested, go to lovelyfinancials.com/planner to get your harmonious cash flow planner. Finally, we want to talk about how your liabilities impact your cash flow for better or for worse. Now, when you don't manage your liability strategically, it can make or break your business. And so let's talk about, how liabilities can positively impact your cash flow. So, one way that your liabilities or like your leverage debt can positively impact your cash flow is through like maybe utilizing a business loan or a line of credit. Please, with all of me, please, 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 please stay away from those merchant loans. They are just have the bait just kind of waiting for you. And it's like you always just need it when you pay it off. So if you can avoid that like the plague, thank you. I just wanted to say that. I don't think that's a great tool for expansion. I feel like it's a if you do use it or if you have used it in the past, just go ahead and just knock it off, pay it off, dust yourself off, and move on. No bad feelings. So what I mean by that is if you have like a merchant account like Stripe or Shopify, things like that, they have what is called like a merchant loan, and what they'll do is give you a lump sum of cash, and then while what you would pay it off daily or every time you make a sale, because it'll take 20%, 15, 18, 20 something percent of the sales that you would get to quickly pay that off. And it might seem, helpful when you're kind of going through a time of when you're going through a tough time with your cash on hand, but it really ends up creating a vicious cycle of repeatedly getting into that debt, paying it off, but then your monthly recurring revenue feels like it's going down because you're paying off that debt versus you paying off a debt monthly. It's like you're paying it off every single transaction. And it just feels like you're perpetually behind. And it's like those companies, they know your sales so much, and they just know exactly when they could predict when you would want it again, and then they'll give it to you again. It might be higher and they'll give it to you again, and then that's like a whole vicious cycle. So please, if you're listening to this video, if you already have it and you're paying it off, um let's just pay it off. And if you're tempted, please do not get it, please. I've been there in the past before. I like to go through things myself so I can like share like my firsthand my firsthand experience. But I've also, helped clients through this as well. And but that was a whole spiel. I think I was just kind of talking about negatively impacting your credit, right? Or not negatively impacting your cash flow. And that would include like a merchant loan. But a positive one would be like a actual term business line of credit, not term business line of credit. So a good one would be a business loan, very specific for expansion. You have to be very specific when you're applying for loans. They want to know, okay, what are you going to use this for? And they want to know if you'll be able to actually pay them every month. So, a way that this can be leveraged in a meaningful way is if you have a conference or like a special project. And that conference or special project, that you're going to get income from it, but your income might be in the future, maybe in 3 to 4 6 months, right? And while you're planning and having to expense some of these things for that conference or special project, it might be beneficial to get like a term loan or a line of credit so that you're not impacting your cash on hand, like your monthly cash on hand, with that special project. And then when you start getting the funds of income from that conference or special project, You could just kind of throw it there, and then you can, have a specific profit and loss statement for that conference or special project to see how profitable it was. And then you're able to positively impact your cash flow because you're saving your monthly cash on hand or your monthly cash activities for that special project. Another way that liability can potentially positively help your cash flow is through, flexible payments with vendors. So again, this can be like a special project, like a conference. Like instead of paying everything for your venue, you can do a payment plan, right? Or deferring payments for vendors over time. Now, this is when I think of a vendor, I think of maybe like a bigger corporation, because I know as a small business owner, you want your cash right now. Now, you don't want to wait net 45, you don't want to wait net 60 or anything like that. Maybe you might have relationships with like a Staples or like an Office Depot, and then you can kind of put things on a net 60. That can be an idea. Or a mid-sized business or something. Whatever relationships that you have, you can potentially use that to positively impact your cash flow. The third way that you can positively impact your cash flow with a liability short term is through, when you are going through seasonal dips, but it's already planned. Maybe you can use that line of credit during the summer, when if you're like, if you know that during the summer your revenue dips extremely, or you're like in between a launch. But we do want to plan for that cash flow wise, and maybe use that as like a last resort. But having these things in place will allow you to be able to not act out of desperation when that dip comes, or if that dip comes. So we talked a little bit about how liabilities can negatively impact your cash on hand, and we talked about the merchant fees. I'm on a tangent on that, so I just want to reiterate the merchant one. The merchant one is the one that's going to negatively impact your cash on hand. This might not be all the time. You might have a way to just utilize it if you have like a product that you want to sell, and you just want to get like your inventory, just kind of knock that out, and then you're going to quickly make that sale. That could work. But you would have to have a lot of discipline when it comes to utilizing liabilities. Um, and one thing that comes up for me when it comes to like handling your credit cards, I know a lot of people talk about like, yeah, you get the best, like you want to use your credit card for points, but if you're perpetually retaining a balance and you're paying interest expense every single month, you're not really utilizing the credit card for the points. It kind of like is null and void, because your cash back or like your points is like extremely lower than the credit card interest that you're paying if you are keeping a balance. So just be really careful when you're using your credit cards. And, late payments is also another one that is negatively impacting your cash flow, because you are paying like an extra $40 every single time. There's another type of loan that they'll give you that lump sum, but you're paying every single week. And, that's not flexible, and that's not going to help you with your cash on hand if you're kind of paying that every single week. And again, we're not going to get into like the mindset behind liabilities today. We will get into that in another episode, but these are just me kind of like listing certain things that we want to pay attention to when we're looking at our liabilities and making decisions on our liabilities and our businesses. So to kind of like tie everything back, we talked about liabilities don't have to be inherently bad, but we want it to be monitored, we want it to be balanced, and we want it to be strategically used. So today I shared some juicy things about liabilities and what you must know about your balance sheet, because she's that girl and she's going to tell it like it is. And we talked about like what are liabilities, short term versus long term, current liabilities versus long term liabilities. And then we talked about how you must compare your assets versus liabilities. We talked about the debt to asset ratio, ideally being about 30% in your business. And then we talked about how liabilities can make or break your cash flow and things that we can use it to like leverage your cash in your business through special projects and how it can negatively impact your business when you are carrying a balance and paying all these interest expenses and things of that nature. So I know this may be a lot for some of you, but if you stuck with me through up until this process, I thank you, thank you, thank you. Let me know what resonated most with you. Let me know in the comments if you're watching on the YouTube version or if you are a listener on the podcast and you want to just kind of give me a little girl, what is you talking about? Or message me, DM me at Harmonious Wealth on Instagram, and I will respond back to you, girl. Or guy. I'm not only talking to girls on here. But again, if you are ready to start tracking your finances with confidence, the Harmonious Cash Flow Planner is for you. Okay. Get your pretty hands on that. Get your handsome hands on that because I want you to understand not only like your revenue and expenses, but your cash flow trends in your business. This is going to help you understand where you're like how you're tracking your liabilities so that if it is a quote bill on your cash flow or in your cash flow, then we can account for it. And then that way you don't have any cash flow surprises months down the line. And if you are ready for this, get your hands on it at lovelyfinancials.com/planner. Okay. If you're a woman and you're growing your business and your family and you want to release the worry around money in your business to build personal wealth and grow a legacy, subscribe on either YouTube, right here on YouTube, or wherever you listen to your favorite podcasts. I'm on a mission to help 100 women or more reach at least 1 million in net worth through creating generational wealth and breaking those generational negative patterns. If this aligns with you, I'd love for you to be a part of this harmonious wealth community. Thank you. I don't know why I did this, but thank you. See you in the next episode. Bye.